Payback period is called investment divided by annual cash inflow, annual profit minus depreciation, cash before taxation or profit. T is the time, R is the rate. SI, PTR over 100. What is P? Principal money. T is the time, R is the rate divided by 100. Number of years, 7. Whole divided by 105 plus 98 divided by 2 into 100. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. BSS, Professor in Commerce and Management, Vidhyaashram First Aid College at Temple of X in MYSURU. In this session, I am going to hand Financial Management 4 semester session 1 in favor of BBA model question paper I am going to solve now, one by one. First 5 marks question, then 10 marks question, then 15 marks question. It is a model question paper. Definitely it will help from the examination point of view. First question, 5 marks question. A 15 years, 12% debenture of rupees 2000 face value issued at par and redeemable at 5% premium. Flotation cost is 2%. Corporate tax is 30%. Find out after tax of debenture. So formula, cost of debenture I into 1 minus T plus redeemable value minus face value divided by N whole divided by redeemable value plus face value divided by 2 into 100. What's the formula? I into 1 minus T means tax plus redeemable value, how we have payback, minus face value divided by number of years divided by redeemable value plus face value divided by 2 into 100. According to this problem, 12% debenture of rupees 2000. I 2000, what's the percentage? 12 by 100. Cancel the 20. This is 240. This I become 240. What's your tax rate? 30%. Redeemable value. Your face value is 2000. How much percentage? Redeemable at 5% payment. 5%. So 2000. 5% of 22,000. Here 2000. 5% of 2000, 0 cancel out. This is 100, 2100. Face value, what's your original value? 2000 minus flotation cost is how much? 2%. This is 2000 into 2 divided by 100. 40 rupees. $2,000 minus 40, 1,960. Tax 30%, 0.3. So redeemable value, this is 2000 into 5 divided by 100, 2100. Apply now. What's your I? 240. 1 minus 0.30 plus. What's your redeemable value? 2100 minus. What's your face value? 1,960. 2,100 minus 1,960. How many years are there? 15 years. Divided by 2,100 plus 1,960 divided by 2 into 100. Simplify. This is 240 plus 2100 minus 240 into 0.70, 240 into 0.70, 168. This is 2100 minus 1960 divided by 15, 9.33. This is 2100 plus 1960 divided by 2, 2030 into 100. So 240 into 0.70, 2100 minus 1960 divided by 15, it becomes 9.33. So 240 into 0.70, 240 into 0.70, 168 plus 9.33 divided by 2030 into 100. It comes to 168 plus 9.33 divided by 2030 into 100. 8.73 is equal to 8.735%. What's your formula? Cost of debenture is equal to I into 1 minus T plus redeemable value minus face value divided by N, redeemable value plus face value divided by 2. 240 into 1.3, 2001 minus 1960. Number of years is 15 years. See that? Divided by 2 into 10. It will come 8.7335. Next one. A project costs rupees 20 lakh and yields annually of rupees 3 lakh before depreciation at 12.5% on straight line method. Tax rate is 30%. Calculate payback period. Your always payback period is the initial investment divided by cash inflows. Payback period. How many years we can pay back? Investment divided by annual cash inflows. Particulars rupees. What's your profit now? Annual profit rupees 3 lakh. 3 lakh minus depreciation. What's the percentage? 12.5% on the cost of the project. 20 lakh into 12.5%. 20 into 12.2 lakh 50,000. Deduct. Difference is 50,000. This is cash before taxation. Minus tax at 30%. This is 50,000. 30% of this is 15,000. So it works out 35,000. Profit after tax. add back depreciation 2,50,000. Add back. This is 2,85,000. Cash inflows. Payback period. Initial investment 20 lakh divided by what is your cash inflow? 2,85,000. 20 lakh 7.01 year. So what's the format? Payback period is called investment divided by annual cash inflow, annual profit minus depreciation, cash before taxation or profit before taxation minus tax at 30%, profit after tax, add back depreciation 2,50,000, cash inflows are 2,85,000. Investment is 20 lakh divided by 2,85,000. It comes to 7.1 years. At what rate of simple interest a principal of rupees 10,000 earns an interest of rupees 2,400 a year? Simple interest. SI is equal to PTR 400. What is PTR? P is the principal money, T is the time, R is the rate. SI, PTR over 100. What is P? Principal money, T is the time, R is the rate divided by 100. Apply now. At what rate of simple interest a principal of rupees 10 earns an interest of 2,400? Interest. What's your principal money? What rate of simple interest a principal of rupees 10,000 into at what rate of simple interest a principal of rupees 10,000 earn an interest of rupees 2,000 in at what rate of interest of rupees 2,400 in 3 years? $10,000 time 3 years or we don't know. Divide. Cross multiply. 10,000 into 3 is 30,000 or it's equal to 2,024 followed by 40. 2,40,000. R is equal to 2,40,000 divided by 30,000. R is equal to 8%. This goes here. Next. What is the compound interest for the same principal and the time at the rate of arrived in the above? Compound interest is equal to P into 1 plus R to the power of n. What's your principal money? 10,000 into 1 plus 0.08 to the power of 3 years. This is 10,000 into 1.08 to the power of 3. 1.08 into 1.08, 1.2597. 10,000 into 1.2597 into 12,597. So 10,000 into 1.08 to the power of 3 is 12,597. Then, a 7 years, 12% preference shares of rupees 100, face value sold at par, redeemable at 5% premium, 2% flotation cost, tax 35. Calculate the cost of this is. Redeemable value is equal to D divided by RV plus this 12% preference share of rupees 100 face value sold at par, redeemable at 5% premium, 100. The premium is how much? 5%. 5 rupees. So redeemable value 100 plus 5, 105. Face value is equal to 100 minus, what's your flotation? 2% means 2 rupees. It becomes 98. So N is equal to how many years? 7 years. 7 years. Tax should not be taken. Should not be considered. KP is equal to, what's your dividend? 12% of rupees 100. D 100 into 12 by 100%. 12 rupees. D is 12 plus redeemable value 105 minus face value 98. Number of years 7, whole divided by 105 plus 98 divided by 2 into 100. This is 12 plus 105 minus 98 divided by 7 is equal to 1 divided by 105 plus 98 divided by 2, 101.5 into 100. 13 this is 13 divided by 12.801. Mention the features of budgeting. So answer budgeting. 1. Decisions involve potentially large fund. This is only in reference to large fund. Decisions involve relatively high degree of risk. More risk will be taken here. Decisions are irreversible decision. Long time gap between the initial outlay and anticipated return. It takes number of years time to get back the return. Decisions have long-term implication. So once you take the decision, it is going to remain for 5 years, 6 years or 10 years. 5 months. Write a note on payback period method. Write a note on payback period. Payback method is it comes under capital budgeting. Payback method is one of the traditional methods of evaluating investment proposal. Payback period refers to the period within which the cost of the project is fully recovered. In how many years we can get back our money. Payback period pays states the number of years required as recover the original investment. If you want to get back the original investment, how many years it take back? Payback period is investment divided by cash inflows. This is a formula. We already solved one problem on these. Merits. Useful in evaluating the projects. Payback period. Simple to understand. Prefer short-term projects. Demerits. It ignores time value of money. Ignores cash inflows after the payback period. So what are the uses are? Useful in evaluating projects, simple to understand, prefers short-term project, demerits, It ignores time value of money, ignores cash inflows after the payback period. Seventh one, write a note on Walter's model. Professor James Walter viewed that dividend decisions of a firm has a direct influence on market price of share and market value of the firm. He says it's a influence on market value of share and market value of the firm. Assumption. Retained earnings are the only source of fund. Retained earnings are the only source of fund. Business risk remains the same. The risk remains the same. The rate of return on investment remains the same. The rate of return remains the same. Firm distribute all its earning as dividend. Formula D R over K into E minus D divided by E. P is the price of share, D is dividend, R is rate of return, K is equal to cost of capital, E is equal to earning per share. D, dividend, R is the rate of return, K is the cost of capital, E is earning, D is the dividend. Hope you understand. These are all the questions which you are going to get the 5 marks question. Hope in the next session we are going to solve some more problems relating to 10 marks, then we'll go for 50 marks. Better to go through these questions and answer. Definitely it will help you. Meet in the next session with some more problem. Till then, goodbye.